It's one of the great ironies in finance, isn't it? You see these incredibly brilliant people, top surgeons, successful lawyers, PhDs in physics, and you assume they must be amazing investors. But so often, the opposite is true. They seem to struggle more than anyone to just match the market.
It's a fascinating paradox. And the hook is it's not because they aren't smart enough. In many cases, it's because they are almost times 2 times smart for their own good. The very traits that made them successful in their demanding careers can become serious liabilities when they step into the financial markets.
Okay, that's what I want to unpack. Shouldn't a brilliant analytical mind be able to spot patterns or opportunities that the rest of us miss? Why doesn't a high IQ translate into a higher return on investment?
Because the market isn't a problem, you can solve like a math equation or a surgical procedure. A surgeon knows that human anatomy is complex, but it's consistent. It doesn't change its rules just because you're about to operate. The market, on the other hand, is an adversarial system.
Adversarial? What do you mean by that?
I mean, the market is made up of millions of other smart people all trying to do the same thing you are. The moment you think you've found a clever pattern, so have thousands of others, and their actions immediately neutralize that edge. The system actively works against your brilliant idea.
So it's not like you're playing against a chessboard, you're playing against every other player at the same time.
Exactly. And this leads to a dangerous overconfidence. Think about a neurosurgeon who has spent 15 years mastering their craft. They're used to effort and deep analysis leading to success. They might think they can solve the market with a weekend of intense research, but they're completely unprepared for a system that doesn't reward individual brilliance in the same way.
I see. That's probably why we see those startling statistics.
Right? Studies consistently show that somewhere between 80 to 90% of active individual investors fail to beat a simple, boring S&P 500 index fund over any significant period, like 10 years. This isn't because they're unintelligent. It's often because they're over trading, driven by the belief that they have some unique insight.
Which brings up the hardest part of investing for a lot of people. Why is doing nothing so often the most intelligent action, and why is that so difficult to accept?
Well, in almost every other field, you are rewarded for your activity. The harder you work, the more you practice, the better you get. In the market, you are often punished for activity. Every trade you make costs money, and more often than not, is based on an emotional reaction rather than a real edge. So, the first hurdle for a smart person isn't learning finance, it's unlearning the ego that came with their professional success.
That makes perfect sense, and I imagine that ego also leads them away from simple solutions. Nobody wants to admit their special brain should just do the average thing.
You've hit on the next major trap, the deep seated love for complexity. For a highly intelligent person, a simple strategy like buying and holding an index fund feels, well, boring. It feels amateurish. They want to feel like they are applying their intellect to the problem.
It's like someone who refuses to take a simple aspirin for a headache. They insist they need a custom compounded medication because they believe their headache is somehow more unique and sophisticated than everyone else's.
That is a perfect analogy. And the financial industry is built to cater to that exact feeling. They sell these complex, sophisticated products, hedge funds, esoteric derivatives, multi-factor models that are often just incredibly expensive versions of the basics. They're selling the feeling of being an insider, of being special.
And there's a cost to that complexity, I assume.
A huge one. Academics call it the complexity tax. The average actively managed fund, for example, has historically trailed the index by about 1.5% per year. A huge chunk of that underperformance is simply due to higher management fees and trading costs. Complexity is often just a fancy cloak for high fees. Simplicity is the ultimate sophistication, but it's a hard sell for a brilliant mind.
It also seems like this ties into the illusion of information. In the age of big data, smart people must feel they can find an edge by digging deeper than anyone else.
Yes, and they often end up drowning in noise, thinking it's a signal. You can picture an analyst staying up until 3 in the morning, reading a 200-page regulatory filing, searching for one tiny nugget of information. The problem is, by the time that document is public, thousands of other algorithms and analysts have already scanned it, and the market has already priced that information in. More information is not always an asset. At some point, it just becomes a distraction.
So, it's not just a psychological trap. There's cold, hard math working against you. Even if you are 1% smarter than average, you can still end up losing.
This is the most crucial part to understand. Investing is what's called a zero-sum game before costs. For every winner, there must be a loser. But once you factor in costs, fees, commissions, taxes, it becomes a negative sum game for the participants as a group.
Can you break that down?
Sure. Let's say the overall stock market returns 7% in a year. A passive investor who buys a low-cost index fund gets very close to that 7%. Now, let's say you're an active investor and you're paying 1.5% in fees to a manager and another 0.5% in trading costs. That's a 2% hurdle. You have to be smart enough to beat the market by a full 2% every single year just to times break even, times with the passive investor. Almost no one can clear that hurdle consistently.
So you're starting the race from behind. Let's talk about that idea of getting smarter. The blueprint mentions the paradox of skill. If everyone in the market is getting smarter and using better technology, shouldn't that make it easier for the truly brilliant to stand out?
You'd think so, but it has the opposite effect. The paradox of skill argues that as the average skill level of all participants goes up, the difference between the best and the average gets smaller. Skill becomes less of a factor, and luck becomes more of a differentiator.
So intelligence just becomes the ticket to entry, not the reason you win.
Precisely. In the 1950s, the market was mostly individuals or dumb money. It was easier for a professional to have an edge. Today, over 90% of trading is done by institutions, algorithms, and PhDs, the smart money. When you try to outsmart the market, you aren't competing against an average person anymore. You're competing against the collective intelligence of everyone else who is trying to do the exact same thing.
So we've established that a high IQ can be a liability and that the math makes it nearly impossible to win consistently. When we put it all together, what's the real takeaway here?
I think it comes down to intellectual humility. The data shows that the most successful long-term investors are often those who recognize the limits of their own predictive abilities. They choose to accept the average market return through indexing, which paradoxically places them in the top tier of performers over time.
It seems the entire game has changed. The competitive advantage is no longer about who has the most information or the highest processing power.
Exactly. As the world gets smarter and data becomes instantly available to everyone, the edge you can get from pure analysis just shrinks. The battle has moved from the realm of times information times to the realm of times temperament asterisk. It's not about what you know, it's about how you behave when everyone else is panicking or euphoric.
And that comes back to your earlier point about activity. The failure of a smart person is often a failure to simply stay still.
That's the core of it. In finance, activity is a cost, not a value add. The desire to do something is an expensive impulse. Patience is the real superpower.
The ultimate irony of the financial world seems to be that the smartest move you can make is to admit you aren't smart enough to consistently win the game. We live in a culture that worships the hustle and finding the edge, but the market is one of the few places where your greatest enemy isn't a lack of brain power, it's the belief that your brain power makes you immune to the laws of probability. It leaves us with a final question to ponder. Are you willing to be boring enough to become wealthy? Or would you rather be brilliant enough to go broke?